All right, with that, let's come into today's core financial insight, which is tax-free income. So what is tax-free income? About maybe 7, 8 years ago, I was in Toronto, and I used to do a lot of business there. And this was my routine when I was coming home. I would rush to the airport. I'd finish my appointment at about 3 o'clock, because if you know Toronto, you know the traffic situations there. My flight was always at about 7 o'clock at night. And I would rush to the airport, grab a sandwich at Tim Hortons, grab a book or a magazine, and that was the routine, right? And this one time I did the same thing. So I was rushing to the bookshop, and I saw a book called 10 Secrets Revenue Canada Does Not Want You to Know. So it caught my attention. So I grabbed the book, grabbed my sandwich. You know, when the flight took off, settled in, when the seatbelt light went off, routine, I took out my book, took out my sandwich. As I read the first page, second page, I felt like jumping out of the plane. You know why? Because it said that it listed the 10 best countries in the world to live in where taxes are the lowest. Okay? Number 1 was Hong Kong, and number 2 was Singapore. And I'm from Singapore. And Canada was like number 8 or number 9. So the point is, we have a very high tax rate here. I don't know, especially when I'm looking around, I see people from different countries. You know, we've got the quality of life in this country is great, and there's, no issue there. That is true, and it's undisputed. But it comes as a cost. Okay, we're a very big country. There's, a lot of infrastructure that's needed. So that's a reason why the tax rates are so high, and this is the reason why the quality of life is so good, because somebody pays for it. Guess who? You, right, with your tax money. Okay? So let's be careful, because, part of wealth building is not only earning money, but conserving what we have, okay? From debts, from taxes. Otherwise, you're just spinning wheels, okay? So we are going to take 3 sessions to learn how to become tax efficient. Remember in my opening I said, help you build your financial house on a bedrock foundation with tax efficient walls. And this is what I mean by that, okay? Wherever possible, we want to make money tax-free. If not possible tax-free, we want to make it tax-deferred. If not tax-deferred, we want to pay the least tax possible, right? And we're going to find out how. So tax-free income basically is income on which, it's very self-explanatory, where you do not have to pay taxes. Is it even legal in Canada? Yes, it is, because people don't look hard enough, all right? There are ways to make money tax-free. All right, so I've identified at least 3 forms. I'm not an accountant, okay? So, my job, I just identify these things, and in specialized areas, we will refer you to the expert, okay? So I've identified 3 places where you can make money tax-free. The first is your principal residence. I don't know if you know this or not. In the U.S., okay, and they're trying to change this because of their debt situation. The mortgage there, when you pay a mortgage for your principal residence, it's tax deductible, okay? And that's a big chunk of your expense, right? In the U.S., it's tax deductible. But when they sell their properties, and they've got rules, I believe it's within 2 years, whatever the rule, but at some point it becomes taxable. Not so in Canada, okay? In Canada, if you have real estate where you live, which is your principal residence, right? If you sell it, all of that gain is tax-free. You do not have to pay tax on that, okay? Now, you can use that creatively, okay? I have the saying that if you are going to buy a house, buy the ugliest house on the richest street. Ugliest house on the richest street, right? And, the market will just carry it. You follow? But so you can just be aware of it, that there's people do move, okay? So it's a lifestyle thing when people move because of job transfers or otherwise, right? But remember that, there's money to be made here too, so why not factor that in, okay? So the first place where you can make money tax-free is your principal residence. Now, let's take an example. John and Mary bought their first home in 1990 for $200,000. As a result of job transfer, sold it in 2000 for $300,000. The capital gain is $100,000. Okay? They bought it for 2, they sold it for 3. Now I've simplified it because there are expenses incurred both during the buying and the selling that will go to adjust the selling price and the cost price, okay? But nonetheless, let's keep the example simple. You buy for 200, you sell for 300, that $100,000 is tax-free, okay? You don't have to pay any tax on it, okay? Now, most people move at least 7 times. Now, I was trying to look for a statistic as to how many times people move, and that's true of me. Suzanne and I, when we, especially in the first half of our lives, we must have moved like a gazillion times before we found our footing, right? But, oh, there you go. 11 times. All right. But people do move, right? Several times for whatever reason. And whenever you do, factor this in that, look, the next time I have to move, all of this is going to be free. Now, somebody mentioned a cottage earlier on. Before 1981, and I'm not a tax expert, I just went to the CRA tax website and read stuff before, as part of my research for this. And again, you want to be dealing with an accountant or a tax expert for this, okay? But I'm just throwing out things just to provoke thought and to sort of point you in certain directions. Before 1981, you were allowed to have 2. Okay, you could have a cottage and you could have your principal residence, and you could designate either one. After 1981, you can only have 1, right? You have to pick. Before you could have 2, now you can only pick 1. You can sort of split them, because some people do spend more time. It's where you spend the majority of your time. If you can justify that, that becomes your principal residence. And sometimes people want to designate their cottage as the principal residence because the gain there is much higher than, it went up much more than their principal residence in the city. You follow? Okay, so just be aware of that. And so this is the first place that you can, and it's quite a substantial amount of money. And I'm saying in a later session, we're going to talk about real estate investing. We're going to do 5 sessions on investments, okay? And one of them is we're going to give you 2 strategies on how to make money in real estate, okay? And you've got to be, there's a lot of money to be made, but in that strategy that we're telling you, the gains are going to be taxable, okay? Because those are properties that you're buying in, they're capital properties. Principal residence, you don't, all right? So be aware of that. The second place that you can make money tax-free is in a tax-free savings account. Now, this is relatively new. It came about in 2009. In the U.S. equivalent of this is the Roth IRA. We didn't have this in Canada. In 2009, the Conservative government came up with this, where you can have a savings or an investment account in which the interest income, interest, dividends, or even capital gains are not going to be taxed, are not subject to income tax. It's a big deal. Okay, so if you structure it right, okay, and in our 10 steps, and I'm just going to show you in a second. When I do the third one, I'll do an illustration there that shows you how we use this, okay, in our 10 steps, okay, in our investment area especially. Because if all you're going to use up to now, I mean, most people do not have a good grasp of what a TFSA is, and they are using it basically as a savings account. They open a savings account, and they invest the money in there in a savings account, in a GIC, that kind of thing. But given that it is going to be tax-free, it's actually much better if you use it for things like dividends and capital gains, because those gains tend to be much bigger. Okay, why pay tax on something that is bigger? Because interest, the return on investment tends to, because the risk is lower, tends to be less. You follow? And I'll just show you in a second. But so just be aware that this exists. Okay, you are allowed to have earn investment income, interest income, dividend income, and capital gains tax-free, as long as you earmark that account as a tax-free savings account. All right? And so it came about in 2000 and 2009, and you're allowed to put each Canadian 18 and over, it's allowed to put $5,000, and it's cumulative. So up to now, in 2011, you are allowed to put $15,000 in. In a couple situation, you can actually save $30,000. One application could be the emergency fund, because as I alluded to earlier on, if you're 2 of you, $2,000 a month, 6 times, that's $12,000, okay? And you might want to put that in a TFSA so that you don't get a T5 at the end of the year. That's what not paying tax means, that it accumulates tax-free. Okay? Different from an RRSP, because this money is you're putting in after-tax dollars. Okay? You're not getting a deduction on the way in, but all of the accumulation is tax-free. Right? So whenever you take the money out, it's that. Now, so these first two you may or may not be aware of. Okay? Like the principal residence, like I said, some people are not conscious or aware of that. And I just wanted to point it out to you that depending on where you are at in life and how many more times you're going to be moving, as far as the principal residence is concerned, kill two birds with one stone. Okay? Make it a lifestyle thing, make it an investment thing at the same time. Because it's going to come. The next time you're going to move, all of that gain can be tax-free. Why not? Right? Stretch a little, do something, but make that happen. All right. And this one here, start using it. Okay? We're coming up with more and more creative ways of using it. So these two. Now the third one is something that you might not be aware of, and that is what I call the Insured Guaranteed Tax-Free Account. Now, before the TFSA, we only had two places in Canada where you could make money tax-free, the principal residence and this. I'd say most people, and even financial people, are not aware of this. Okay? The Insured Guaranteed Tax-Free Account, aka permanent life insurance. If you go to your banker tomorrow, okay, wherever you do banking, and most of you do not do PC Financial. In PC Financial, there are no bankers. They might have these kiosks with representatives, and that's why it's free, because there are no frills, right? But if you go and see a banker tomorrow, and I'm going to pick a 40-year-old, let's say. You're 40 years old, you go to your banker tomorrow, and you tell your banker, I want to set up a savings account, okay? And I'm going to put $1,000 into that account every month. Okay? I've got the cash flow. I'm going to put $1,000 into that account. But here's what I want in return for giving you the business. $1,000 every month into that savings account. Here's how I want you to structure it. That if I die between my first deposit and my second deposit, okay, I want you to pay my family not just $1,000. I want you to top it up by another $999,000. Make it $1 million. Okay, right? And then you tell him, whenever I want to, I'd like to take, and while this money is accumulating, okay, I don't want to get a T5 at the end of the year. You follow? Don't give me a T5. Okay, I don't want to receive a T5. I want the interest to accumulate tax-free. Okay, and then I want you to give me a loan whenever I need money, right? These first two conditions still hold. And whenever I need money, I need you to give me a loan, and I'm not going to pay you back the loan. I want you to capitalize the interest. Just add the interest to the loan, right? Are you following me so far? So first condition is you tell the banker, I'm going to put $1,000, open a savings account, I'm going to put $1,000 in there every month, and if I die between the first and second deposit, or whenever, I want you to top it up to $1 million, okay? $1,000, top it up to $1 million. I don't want to pay any interest. I don't want to pay any tax on the accumulation, right? And I want to be able to borrow without having to pay you back, without having to make any payment. There is no banker in the world. They'll show you the door very quickly. They'll ask you, what have you been smoking? All right? So, but who cares what the label is, right? I'm not concerned with labels. I'm concerned with results. That's exactly what a life insurance policy is. If you are a 40-year-old, it'll cost you 1%, about approximately one. I'll use the example. Okay, 40. If you are in your late 40s, right, it'll cost you 1%, 1/2 of 1%, or 1% for the insurance. Okay, so if you've got $100,000, right, 10% is $10,000. 1% is $1,000. Okay, so if I make that $1 million, 10% is 100,000. 1% is 10,000. Right? On a monthly basis, 10,000 is about what? $900. 9 times 12 is 10,008. Yeah. So if you're paying, the example that I use is for a 40-year-old. If you're a 49-year-old, okay, late 40s, you can buy $1 million permanent policy for approximately $900 a month, about 1%, the factor that I'm using, 1% of the face amount, which is what this is. So until, you know, most people, as soon as, because it has to do with, there's a lot of reasons for this, but as soon as you bring insurance up, the walls come up, okay? You know, they want the cheapest. People don't really understand this properly, okay? But this is one way that you can accumulate money tax-free, okay? So let me just give you an example. The strategy that you would use this is like you would own a permanent life insurance policy, and I'm going to tie it into the 10 steps in a second. Just let me go through the strategy first, and it might become clearer. First thing you do is you own a permanent life insurance policy, whether it's a universal life or whole life. Now, for those of you who do have life insurance, it's probably through your creditors or your group insurance at work. You probably have what's called a term insurance policy. It's got a term, temporary insurance, okay? If it's a group insurance policy that you have at work, it is a one-year term. Your employers negotiate with the carriers every year. It may not be known to you, but whoever the administrator is, they're negotiating with the carriers every year, just like the home and the car insurance. They negotiate, and based on your ages, you know, it's adjusted. It's a one-year thing, okay? Then you've got people buying term policies. You keep seeing ads on TV, the various banks and insurance, they got guaranteed issue and whatnot. Those are term policies. There's a specific term to it, either till age 65 or 10 years or 20 years, okay? For the longest time, there was only two kinds of policies, term and permanent policy, whole life policies. In the early 80s, in the high interest rate environment that was in this country, and I'm not sure if it was in other parts of the world, there was a big outflow of cash from insurance companies to other financial institutions like banks and trust companies. And the reason for that was people were borrowing from their whole life policies, which were paying 4%, and they were guaranteed a loan rate of a spread of 2%, 6%, and they reinvested the money outside at 18, 19, 20%. Savings accounts were paying that much there. So there was a big outflow of cash going out of insurance companies, and to correct that, they came up with this policy called the Universal Life Policy, where they said, look, you don't have to do that, okay? In the Universal Life Policy, you can pick the investments that you want. You don't need to take your money out and go and invest it elsewhere. Instead of getting just 4%, you pick the investments, right? So those are what we call permanent policies. All right, so the first thing you need to do, and I'll explain why you need to own them later on, but just let's say you own them for now. Second thing you do is you overfund them, okay? Because in these policies, you've got a savings portion called the accumulation fund, right? And what you want to do is overfund them. You're allowed to put in more money in there than what's required just for the policy. You overfund them. Once you overfund them, in the accumulation fund in a policy, it's tax deferred. You don't have to pay tax on it because it's in the because it's sheltered by the policy. It's part of the policy, so it's not a separate investment account. And hence, you will not get a T5 or a T3 at the end of the year. It's tax deferred, it's tax sheltered. The third thing you do, you accumulate money over your lifetime in that policy, and whenever you need money, what you do is you assign the accumulation account as a collateral for a loan with the interest capitalized. That means no loan repayments. All the things that I talked about when I said when you go and see the banker, these are the things you would have asked the banker, and he would, you know, for the life of him, never agreed to it. But this is what we're doing here. You own a life insurance policy, you overfund it, and once it's overfunded, you assign it, you set up a collateral loan, okay, with the interest capitalized where there's no loan repayments. Then you use the tax-free death benefits to pay the loan and the capitalized interest. Okay, so let me make it clearer. Okay. So we've got a life insurance policy, and I'm just with a permanent life insurance policy. Okay, let's use that example that I gave you. This policy is worth $1 million. Okay? And the client is paying premiums of $12,000 a year, $1,000 a month. And they don't let these numbers frighten you. Just move 1 0 down. If you're looking at 100,000, then it's 1,200. Okay, so let's just work with that number. So when this client buys this, okay, this is what he has, right? In this policy, there's a death benefit of $1 million, and that death benefit by tax legislation is going to be paid tax-free. Okay? Death benefits are tax-free. So hence, the third way to make money is through death benefits. But then you're saying, death benefits, I have to die to collect. I don't want to, what good is that for me, right? So here's how you use it creatively while you are living, okay? We do have to take care of the people that we care about, okay? Because, when we are gone, they still live on. But again, if we can benefit me too while I'm living, why not, okay? Let's make that happen. So this is the third way that you use tax-free income is by making using death benefits, okay? So you buy a policy, make it a permanent policy, you've got a death benefit of $1 million, right? And instead of saving your money elsewhere in a TFSA or somewhere else, you overfund the accumulation fund, the savings account, accumulation account. In the policy, there'll be an accumulation account known by other names. In a whole life policy, it's called the cash surrender value, okay? But that account, you are allowed to put in, and this is something that they negotiated with the tax department, okay? Because the tax department is very aware that money can be sheltered in a life insurance policy. So what they've done is they say, okay, fine, you can do it, but only to a certain amount, okay? Based on the amount of the insurance. They call it the MTAR line, okay? When you go across the MTAR line, then you are paying, it becomes taxable. The insurance companies with computers nowadays, they ensure that it's always below the MTAR line, right? So you are told from year to year how much you can put in there. So you accumulate this, and you keep accumulating money in here, and you just keep building it up, right? So when the time comes and you need money, for whatever reason, you want to retire as part of your another income stream to supplement your retirement income, or you need just a certain amount of money to buy a boat or whatever, whatever your need is for medical emergency. Otherwise, what we do is we go to a third financial institution. Let's say this is financial institution A, okay? We go to a financial institution B, another financial institution. This is an asset, okay? Any banker, any lender, okay? When you show them this and say, look, I've got a life insurance policy that's worth $1 million. I've got $500,000 accumulated here, okay? They will use this as collateral. Why? Because they're almost guaranteed to get their money. But you have to assign the policy to them, okay? Assign it to the extent of the loan, all right? Now, so this is the way it began. And it was very difficult to do because, you had to go and educate the financial institution B, and, many of them are not even aware of it. And what are you talking about, So what has happened in the last 20, 25 years, it's become seamless, okay? Because if this is what you want to do, there's even one company now that has its own bank. It owns a bank, okay? It's one of its divisions is a bank. So this is seamlessly done. We do it all in one sitting. We set up the policy, we set up everything together, okay? So here's where the tax-free element comes in. That now financial institution A does both, okay? It sets up the loan at the same time, the collateral loan, right? So whenever you need money, and this particular institution, the one that I deal with, even gives you an ATM card. Once it sets up the loan, it gives you an ATM card. It gives you checks. Okay? So if I've got $500,000 in here accumulated, why do I put it here versus anywhere else? Because if I put it anywhere else, I'll be paying tax on that money on the earnings. Okay? In here, because it's sheltered in a life insurance policy, I don't have to pay tax on it. It's sheltered, right? While it is earning money sheltered tax-free, I didn't pay a cent of tax on it. But when I need money, if I did it in some other, if I put it into an investment account and I have to take it out, I have to pay capital gains tax or whatnot, right? Here, I won't do that because with this collateral loan, I'll just take the money that I need. So let's say at a point, I started, wanted to supplement my retirement income, and I said, look, I need another $1,000 a month to supplement my income. So I'm going to withdraw $1,000 every month, okay? So $12,000, and over the years, and I did that for, let's say, 10 years, and I've used up, and this balance now is $120,000, okay? There's interest that you pay on it, very minimal interest. And let's say with the interest, it came up to $130,000, right? Now, when I took that $1,000 every month, I just write myself a check, or however you want to set a direct deposit, whatever. I don't pay any, this loan, I don't have to pay it back. The interest gets added to the capital. It's capitalized, right? Now, the day that I die, okay, this is how they handle this. The day that I die, the life insurance policy says, okay, you have a life insurance policy of $1 million, right? We have to pay out $1 million. But there's a loan assigned to this policy, okay? And at this point, you've used up 120 plus interest, $130. So we're going to pay out the tax-free death benefit of $1 million, less the loan, and the balance goes to the beneficiaries, okay? Now, did I lose you, or is there any questions? Why do you have to overfund it? Because you don't have to overfund it. There are built-in, it's just you have the room to put more money in. Why would you want to put money where you have to pay tax? This is why I'm saying tax efficiency means wherever possible, I want to make money tax-free. Whenever I cannot make money tax-free, I want to make money tax-deferred. And then if I cannot make these two, I want to pay the least amount. That's what tax efficiency is. So here is a way to make money tax-free. Because really, if you do this outside, okay, in an investment account, in a GIC, you're earning interest or dividends or capital gains, you have to pay tax on that. Whereas here, you don't have to pay. See, this money that's in here, you have never paid tax on it, okay? And then when you took it out, you didn't make any payments, right? And at the end of the day, it's all being paid out by tax-free money, because death benefits are tax-free. All right? Go ahead, Joe. Inside the policy.
So if your life insurance policy is through Manulife, I mean, you don't get a bank account through Manulife, right? The bank account is through your regular bank account.
Okay, clarify the question. Are you asking me if this, okay, are you confusing, are you talking about this or you're talking about this? You're talking about this? The accumulation account. Okay, all permanent life insurance policies, whenever you have a permanent life insurance policy, okay? Permanent meaning say that it doesn't expire, okay? Unless it is what's called a term to 100. That's a pure term policy. A term to 100 policy is a policy that goes up to your age 100, and then it gets paid up, okay? There's no accumulation. No, perhaps another way to instead of permanent is participating, okay? So these are participating policies, where you participate in the gains of the company, the returns of the company, okay? Now, all permanent policies have a savings element to it. It's called by different names. In the universal life, it's called the accumulation fund. In whole life policies, it's called the cash surrender value account.
The accumulation account is like a bank account.
It is. Oh, yeah.
So, okay, I just didn't know that like a company like Manulife would have a bank account.
They do. Okay, I didn't want to add to the confusion, but you brought up the name Manulife, so I'll deal with it. The company that I was telling you that owns a bank is Manulife. Manulife has a bank called Manulife Bank, okay? And that's different from Manulife that sells the life insurance company that sells insurance, right? But it's good that they do this because now it's seamless. I've set up some of these, okay, and it works like charm, right? For the people who get this, once you understand this, why would you want to pay tax if you don't have to pay tax? Defer it. We're all going to die someday, and when we do, that will have to pay out. And when that pays out, the loan gets taken care of. Okay. Let me tie this in. Maybe it'll become clearer if I tie it into the 10 steps here. See, the reason why in the 10 steps that we talked about, okay, I said that based on Genesis 41, we take a minimum of 20% of your income and we cycle and recycle it through steps 2 to 9 of the 10 steps to financial freedom, all right? So how do we do that? How do we distribute that? And I'll tie this into this here in a second. Okay? Here are the general guidelines, okay? It's different for everybody, but in general, what you would do is take about 5% of that 20% for the insurance, the optimal insurance. Okay, immediately, 5%, okay, for that. You're going to take about 15% immediately, and most people carry some kind of debt, right? For debt reduction, debt elimination. Right? Until you are debt free. Okay? Once you are debt free, you're going to recycle that 15%. Remember in step number 4, in that case that I talked about, as soon as he finished the last one, he got $700 available to him. As soon as that becomes available, he recycles it into step number 5, which is optimizing the insurance. Once you've done this, you recycle the same amount into savings. Okay? And I make a distinction between savings and investments because savings are liquid, accessible, short-term. Investments are long-term, okay? And that's how you're going to make money because if you're trying to time the market, good luck, right? With the volatility that we have and the uncertainty that we have. All right, savings until you've got a 6-month emergency fund, right? Once you've built up your 6-month emergency fund, the insured guaranteed tax-free account is where you build your war chest in terms of investments. Insured guaranteed tax-free account. Now the way it's done is like this. In step number 2, you minimally insure. Okay, like I said, don't bury your head in the sand. You might leave home one day and not make it home. Every time you hear an ambulance, okay, somebody's not making it home, right? So make sure that you insure it. At this stage, and especially if you've got debt, chances are you don't have the cash flow to buy a lot of permanent insurance, right? Chances are we're going to be buying lots of term insurance here, okay? And we're killing 2 birds with 1 stone there. One is that you address the need, okay? You buy as much, it's quantity that we want, as much as we can get, okay? Because term insurance is cheaper than permanent insurance, and so you buy as much quantity as you can get to cover your needs. Now, because your cash flow is low, we're going to buy term insurance here. Once this is done, and we've done this one here, we're going to go back. Here we bought, when we optimally insured for life and health. And by health, I mean disability, critical illness, and long-term care. In our previous sessions, and I took the time to do this, there was 5 sessions on insurance, okay, deliberate. Not something you want to gloss over, okay, because it's going to affect you when it happens, and it's going to happen. This is why we took 5 sessions at the very beginning to deal with each one of these insurances. All right, so you've got 20%, 5% is doing this, and the life insurance here will be term insurance because you don't have the cash flow yet. Okay, you're going to buy as much as you can buy, but term insurance, okay? In doing that, you also protected your insurability, okay? Because these insurances are convertible, okay? Because if you buy a 10-year term policy, that means at the end of 10 years, the rate is going to go up. So at some point, we go in with the idea that we are going to convert it somehow, okay? At some point. But in buying term insurance, if let's say 2 years into it, you are diagnosed with cancer, for instance, okay? Or you have a heart attack, or you got a stroke, any one major illness, insurance companies won't touch you with a 10-foot pole. Why should they? They're in the risk business, okay? Assessing risk. If you are high risk, why would they want to insure you? Because, the likelihood of them paying out is higher. So, but once you have a policy, a term policy, they can't refuse you because the convertibility is without medicals, right? You have a built-in right to convert, okay? So you've protected your insurability, and at the same time, you've got some protection here. When you've done these 2, the first thing we're going to do is go back and convert this into a permanent policy, which gives us our insured guaranteed tax-free account. Okay? And then going forward, this 15% is where we're going to overfund this accumulation fund. You understand? Okay? And this is where we do this. Now, for majority of people, if your values are eternal, you won't go beyond this. Why? I'll tell you why. If I can give you an account, and one of the companies that I deal with, contractually, in black and white, okay, we guarantee you 4% return on this, okay? And through the mechanism, through this strategy, this 4% that you're earning on the money here is not only tax deferred, it's tax free through this strategy. Because at the end of the day, you didn't pay a cent in tax, because everything was paid out with the tax-free death benefits, the loan and the interest, right? So you ended, while it was accumulating income, you didn't pay tax on the income because it was deferred, it was sheltered in the policy. Then you took money out and you used it, and the interest was capitalized. You didn't pay any loan repayments, okay? And then when you died, the death benefit that was paid out was tax-free. It was used to pay off the loan plus the interest, so really you didn't pay any tax. Not while accumulation, not while you used the money, so you used the money tax-free, okay? So when I meet people for the first time who are not aware of this, my proposal to them is this: if I can show you a way to make 4% of your money tax-free, okay, guaranteed contractually, why would you not do it? Because tax-free 4% is equivalent to 8% out there, okay? And if you've looked at our stock market indices, depending on the time period that you're looking at, 8% is pretty healthy, okay? So we're giving you this. So this is why I say for most people, we won't go beyond this. So coming back to my example, that 32-year-old that I sat down with recently, who was going to be making a gazillion dollars very shortly, I told him that, look, you know, your lifestyle is based on $4,000 now, okay? Let's bump it up to $10,000. And let's take all the extra money that you're going to be making, because you're not depriving yourself. If you're making if you live on $4,000 now, and I allow you to live on $10,000 a month, then you've got lots of room to breathe here, okay? But let's do that. Can maintain your lifestyle at $10,000 for the next 15, 20 years. You're not depriving yourself in any way. Then let's take all of the extra money and invest and shove it into that policy, right? In no time, we're going to have $10 million in there, okay? And when we have $10 million in there, we set up the collateral loan at 4%. It's, you know, that $10 million is earning at least $400,000 a year. And he can take out just the earnings out, okay, $400,000 a year, okay, without shrinking the capital. You follow? And that's like $35,000 a year, $35,000 a month tax-free, okay? So this is why I say for most people, you know, if you are not about, you know, if you ask people who think that this is all there is to this life, okay? And so they have a list of things that they have to do before this life is over, because this is all they got, right? But if you are not like that, if, you know, our purpose in life is to evangelize and disciple others, okay? Anybody disagrees with me? Like, you know, our purpose in life is to evangelize and disciple others. But how many of us can say that that is number one on our list? We're busy doing other things, okay? It's not a number one priority. And many a times, it's because we are so bogged down by everything else. Debt, for one, right? All right, so for most people, you would stop there. You don't need to go further than that, because if I can do this for you, you don't have to worry about where interest rates are going. You don't have to worry where the market is, because you've got guarantees here, okay? Either way, you know, you're having your cake and you eat it at the same time. But depending on how much time you have, and depending on, you know, where you are at in life, you might want to go further, okay? And if you want to go further, we're going to go into 3 other things. And we are going to do this in our latter sessions when we talk about investments. The first one is we're going to go into stock market investing. We're going to go into real estate investing, and we're going to go into business investing, okay? Now we're going to do that because of something called and ROI, return on investment, and the rule of 72. Okay? The rule of 72 says that if I take the number, it's a rule of thumb, that if I take the number 72 and then divide it by any rate of return I'm getting, return on investment I'm getting, the answer that I get is the time it takes for money to double at that rate. Okay? So 72 divided by 4 is 18. Okay? At 4%, money will double in 18 years, right? So I put $10 million there, it's going to take 18 years for the money to become 20 million. Okay? But as long as you don't eat up into your capital and just, this will grow. Okay? The reason why we would do these things here is because depending on where you jump into the process, you might not be able to accumulate this very easily, because depending on how far you are into it, right, and how much debt you have and whatnot. So some people might want to do these things because in the stock market, we are shooting for a return of investment of 15%. Here we are shooting for a return of investment of 30%, and here we are shooting a return on investment of 50%. Okay, now very high, because the risks are higher. Why would I bother to take my money and put it here, when I'm earning 4% here guaranteed? The only reason I'm doing it is because the returns are higher and the risks are higher. So let me come back to the 3 strategies, and I told you earlier on that the tax-free savings account, many people are now using it just as a savings account to accumulate emergency funds. That's one use of it. Okay? Another better use of it, I think, is here. When you set up this account, make this the tax-free savings account. Why? Because now that you make this 15%, okay, because it's a tax-free savings account, it's the gains are going to be tax-free. You don't have to pay tax on this. So this is 15% after tax, right? So you make this the tax-free savings account. This here, the real estate investing, we are going to do 2 strategies. One is foreclosures, and the other one is tax sale purchases. Okay. Now, because we are buying them at deep discounts, this is possible. Okay, not easy, but it's possible to do, and you can do 1 or 2 per year. 30% here is taxable. This is not a tax-free savings account, so you're going to pay tax on it. But even at the 50% tax bracket, after you paid 15% in tax, you end up with 15% after tax. 15% is better than 4%, because in the rule of 72, 15% would double in approximately 3 to 4 years. Okay? So money can double in 18 years, or money can double in 3 to 4 years. Now, for people who have the luxury of time, you see, if you start this in your 20s or in your 30s, you've got the luxury of time. Okay? But if you're doing it a bit later, you might have to do some of these things to accelerate the growth of your pot here, before you hang up your shoes, or have to hang up your shoes because of health reasons. You follow? Okay. So this is how this is all tied up together. Are there any questions? I might, when you're seeing this for the first time, it might be a bit overwhelming, but if anything, I just wanted to create awareness. Awareness that, look, there are 3 ways that you can make money tax-free. One is through your principal residence. So whenever you are in a move situation, okay, don't just make it a lifestyle decision. Okay, make it an investment decision too, because understand that the next time you sell this place, all of that gain is tax-free, right? So like I said, just to remember, just a memory jogger: buy the ugliest house on the prettiest street. Okay, chances are you'll make money when you move the next time, right? Second one is the TFSA. You are allowed to put up to at this point up to $15,000 into a TFSA. Okay, don't just blindly put your money in somewhere else, and then at the end of the year get a T5 or a T3, which you have to report on top of your employment income, which just throws you into a higher tax bracket, marginal tax rates, progressive tax rates, right? Next margin. And this one here, I know if you're seeing this for the first time, it might be a bit overwhelming, but I wanted to create awareness, okay, that this exists, okay? And it's been done. I've done a couple of these, okay, for people with a lot of money, and it works. All right. The first person that I did this to never bought a policy in his life. Okay? Never bought a policy in his life, and all I said to him was, if I can show you a way to pay less taxes, would you listen to me? Will you be open to the idea? And he said yes. He said, I'm always willing to pay less taxes. I'm always ready to pay less taxes. And when I showed him this, never bought a policy throughout his life, ended up buying a permanent policy. Not because he was interested in leaving money for his kids or his family. He didn't want to pay tax. Okay? And it works perfectly. All right. With that, I'll bring this to a close. Are there any questions with respect to anything that we did today? We did two things here today. First is we reviewed the GPS process. So first, on the GPS process, are there any questions on the GPS process? No? Then on the second part of today, the tax-free income, the principal residence, the tax-free savings account, and the insured guaranteed tax-free account. Any questions on those? Go ahead, Joe.
So I understood the permanent insurance, and I understood the accumulation account.
Mm-hmm.
But what was the purpose of the loan? You said go to financial institution B,
Mm-hmm.
and you take out the loan.
See, when you have money in a policy, just like in any investment account, like for instance, if you have let's say you go to an investment house and you open an investment account and you buy stocks, right? And you bought a stock for $1,000 and it went up to $100,000. It's nice. The $100,000 is on paper, right? It's a gain that's there. But if you want to use the money, you have to cash it in. Okay? You have to cash that gain in. You have to take the money out. It's when you take the money out that you have to pay taxes, right? So the reason why we have to go to another institution, we can't take the money out of the policy. Because if you have money in an accumulation fund, like any other investment account, when you take money out, it's disposed. Okay? That's when you pay taxes on the gains that have been deferred. So to work around that, we don't take the money out of the policy. So there's nothing to pay there. We take it from a loan against the policy. Because this is a collaterally assigned loan, all these companies and, when they design these products, it's always done with the legal and tax departments. Again, they have to be on site. Okay? Because if they're not on site, then we're in trouble. So they worked it out with the tax department that as long as the loan is an assigned, collateralized loan, it's not a disposition. Okay? It's like me going to the bank tomorrow and saying, look, I need another $1,000 to supplement my income. Can you give me a loan of $1,000 a month? If the banker agrees for whatever reason to give me a loan of $1,000 a month, do I have to pay tax on that money? No, it's a loan. I have to pay interest, but I don't have to pay tax on that money. Same thing here. It's a loan. Except that it's been sweetened because I don't have to pay back that loan. It's collateralized. The interest is added to the loan. And the only reason the lender is willing to do that is because of this policy that's going to be paid out someday. They know. It's just a matter of time when this policy is going to be paid out. And when they get paid out, they get first dippings because that loan is assigned, that policy has been assigned. Okay? So they're not afraid. It's secured. Okay? They're guaranteed to get their money back. So that's why they let the interest be capitalized. But for you, go ahead.
So a follow-up question. The size of the loan, is it based on the face value of the
Accumulation fund.
or the accumulation fund?
They will not go to more than 90% of the accumulation fund because they always want to make sure that the policy is alive. You follow? And they will only let you eat up to 90%. So, but, nobody in his right mind, okay, we are always afraid. One of the issues in retirement planning, which is one of the sessions that we'll be doing towards the end, one of the issues in retirement planning is how do I make my money last, okay? At the end of it, because of health reasons or other reasons that you need to stop working, you've got a pot of money, okay, however you have it. People in that stage of life, their challenge is, how do I make this last? Because I don't know how long I'm going to live. You follow? And so nobody in his right mind uses all of their money anyways. So it's a neutral thing. Okay? So despite the fact that your accumulation fund is 90%, you only get to use 90%, even in a regular situation, you would have never used it all. I mean, I would be worried if I was in my 80s and my bank account has gone down to got enough just to last 6 months, that kind of thing. What am I going to do then? You know what I'm saying? Does that answer your question? Good. 90% of the accumulation fund is what they'll let you borrow out of your policy, maximum, because they want to keep the policy alive because they want to get paid at the end of the day, right? So it's go ahead.
What you're saying is that
Absolutely. Absolutely. Like, number crunchers, accountants, and people who are, who are engineers, who are very analytical, they've taken this apart inside out, okay, because they're analytical by nature. The numbers work, okay. Mind you, the insurance companies and the lenders, I mean, they're not, very generous people. They protect themselves too, okay. They don't give anything for free. They know that this works for them. Their interests are taken care of us. But our concern is, we end up paying no tax. So I'm saying, I just wanted to sensitize you that this exists, okay? And you would be very few people who know. In the accounting profession, because we deal with a lot of accountants, for some reason, a lot of accountants are not aware of this, okay? And if you look at, the books that are put out by accounting firms on personal tax planning, all of the major firms put out a book every year. My accountant sends me one every year. He's a small accounting firm, but still he sends me one from CICA, which talks about, personal financial planning and taxes and whatnot. There's a little blurb in there, three line passage. And by the way, you can use the accumulation fund of your life insurance policy. You can accumulate money tax-free, tax deferred in a life. They don't give it more attention than that, but I think it's such a waste. Okay? That there's more to this than that. So when I said that most people in my market, okay, will stop here, because really, if your purpose in life is to evangelize and disciple others, right? Once your needs are taken care of, why did you want to worry about all of these things? You really don't need to do all of this. Once you've got this, like that individual, I mean, if I can arrange for you to get $35,000 a month tax-free, right? Just take your experience, your expertise, whatever field you're in, go and make the world a better place. Time is running out, right? And do what we're meant to do. All right, any other questions?
In your experience,
Mm-hmm.
who is too poor to look at this?
Sorry?
Who is too poor to look at this? Because you still need some.
Absolutely. Absolutely. It's not in the 10 steps to financial freedom. This is why I'm saying to you, okay, when I position myself as a financial architect, because the metaphor of a financial home makes a lot of sense to me, okay? We will not live in physical homes if we didn't put in if the foundation was shaky, right? If the thing, the walls couldn't keep out the elements, if the roof was, so laden that it was going to sag in. Yet, we do that with our financial homes, consciously or unconsciously, right? So to answer your question, who is it for? Which, it takes resources, I agree with you, but it is my experience that it's not the amount of money that you make, okay, that determines your financial state. It's how you handle that money. You follow? So you've got one extreme, those who make minimum wage and very low income, for whom, survive, just meeting needs is an issue, okay? But even for them, I don't exempt them from tithing, okay? Because remember in the parable of the talents, the fellow who got 1 talent, there was accounting for him too, okay? He was held accountable to it. Just because you got 1 talent, you didn't get 5 talents, you're still going to be held accountable. But the people on the low end, okay, let's say, people with minimum wage and very low income, their challenge, it's very hard for them to get past these steps. If they can get past these first 5 steps, it's already great. And you're right. For people with the resources, if you have the wherewithal, the income to do this, okay? And by income, I mean, $75,000 and up, okay? Because below that, between your needs and your minimal wants, it eats up everything. And this is why people are in debt, okay? The example that we used in when we did the reverse debt snowball of the real life case, the example that we used, 49, 44, and they had $315,000 in debt, and yet between the two of them, they were making 70 and 44, almost $110,000 family income, and they were burdened by the debt. Okay, they still needed debt to tide them over. So yes, okay, this is really for people on the other end, but even the people on the lower end, if they can clean up their act, this is a great way to do it, because they cannot accumulate the money fast enough. right? Uh, if taxes are eating into it, and if they don't have a lot of money going in. See, and coming back to the example, I'm saying if I'm poor and all I can save after I've cleaned up my act and all I can save is $200 a month, if I put it into a savings account, how long is it going to take to accumulate money? And if I die along the way, the banker is not going to top it up to $100,000. You follow? It makes more sense to put it into the insured guaranteed tax-free account. All right. I'm running out of time here, so I just want to finish off with some closing remarks. I want to thank you and commend you for being here today. Okay, I know you had choices with your time, and you chose to be here. I want you to know that I will never take you for granted, right? Jesus said that, you know, in John 8:32, you will know the truth, and the truth will set you free, okay? My mission, our mission, I have a partner there, my mission, our mission, is to empower people financially with biblical truth on money, okay, that come from the Bible. And you can help us towards that end, right? I'm very pleased, I'm, you know, just tickled pink to see all the seats filled up today, okay? It was one of our best showings yet. But you can help us. My pastor, about 2 Sundays ago, talked about the Titanic, okay? And he said something that, you know, intrigued me. He said when they were doing the investigation on the Titanic, one of the things they asked the people, as it is, there was not enough lifeboats, right? And then they asked the people who were in the lifeboats, why didn't you pull more people in, okay? And one of them said, because they didn't apply. They didn't apply to come into the boat. Right? So the pastor said, you know, if you see somebody drowning, do they need to apply for you to help them? You know, so I take that and I extend that to what I do. You know, for the longest time, I've always considered myself, I know I'm a salesman, but I've considered myself a farmer, not a hunter. Okay? The hunter salesman goes out there, chases everybody, you know, and people don't like that. They feel harassed, right? I've considered myself a farmer. I sow seeds, okay? And whoever wants to take, you know, just like the sower, will go. But then when I heard my pastor say that, I'm going to change things a bit now, because if people are drowning, I shouldn't wait for them to apply. I should pull them in, right? And I'll extend this to you, okay? In the next 90 days before you see me, you're going to rub shoulders with family, with friends, co-workers, fellow students, okay, who are drowning financially, okay? They are not tithing. They are not insured. They are not debt-free. They do not have an emergency fund, and they have little or no savings whatsoever. They do not have a financial goal. They do not have a financial plan, let alone a biblically based one, okay? Help them. Help them, how? Invite them. You come here by car. If you're planning to come back by car, make sure your 2, 3 other seats are not empty, okay? Invite someone and, you know, tell them I'll pick you up, bring them. Okay? There's a breakfast, just jump into your shower, dress up, we'll bring you, and, you know, we'll get you out of here by 10:30 latest, right? Bring them, because it gives you an opportunity whenever you do that to bond with people. You talk on the way here. You talk about a lot of things, okay? More importantly, they will see the light of Christ in you, right? And it'll, you know, make them wonder about a lot of other things, all right? So with that, I want to thank you again, and I look forward to seeing, do fill up the survey forms before you go, and I look forward to seeing you in the next 90 days. God bless you.